morning, good afternoon, good evening, traders from across the globe. Welcome to Short-Term Trading Live with Oscar. Traders, this video is being filmed on Sunday evening for Monday's trading. That would be August 10th, 2009. Traders, you know I like to start off with the news on my weekend webinars, and this is a weekend webinar. On our weekend webinars or during our weekend webinars, usually we discuss a lot of the news that we find in the industry newspapers. I'm talking Investors Business Daily, Barron's, Crane's, you name it. We read all of it, and then we take a look at the flavor that these articles produce, or I should say that these magazines produce. What's the flavor now? Is it bullish? Is it bearish? And I can say this. Once again, the news looks good compared to everything that we've had to deal with for the last year and 3 quarters. Suddenly, the news is looking better and better each week that you read it. What I mean by that is, once again, here's what we have from last week. Unemployment dips in July 0.1%. It dips from 9.5 to 9.4. It's the first decline since April of 2008. Now, on top of that, companies shed 247,000 workers last month. And that, while that sounds horrible, it is way, way fewer than we expected, because the expectation was 335,000, and last month was 445,000 lost, or the month before. So June is starting to, since June, it's been starting to look much better again. Employment, imagine unemployment coming down a little. Now I know the government hiring, and it's about car companies hiring and who's not working and who's not looking for work. You can come up with anything you want to poke holes in that, but the fact remains that news is looking better, unemployment is looking better, and it will continue. While still not a welcome event, it's certainly good fuel for the recovery of our battered markets. So traders, I'll tell you what, I kept reading and reading, and yes, there were some negative articles, but most articles were positive. AIG let me start like this. AIG posts profit this quarter. It's AIG's first profit since 2007. Imagine that, AIG posted a profit. Holy cow, wait, there's more. Freddie Mac posted a profit of $768 million and indicated it may no longer need federal aid. Imagine that. Then another headline, owners expecting recovery by 2010. What does that mean? A survey by Administaff says over 58% of small business owners expected a recovery by 2010. Additionally, 14% of those surveyed expected the recovery to happen the 4th quarter of 2009. Again, that's not bad, right? What else is in the news? Ford, imagine this. Ford July sales up 2.3%. Ford up 2.3%. It's the first monthly U.S. sales increase since November of 2007. Traders, this number is from before the cash for clunkers deal began. So they already had increased 2.3% before the cash for clunkers deal. Next, you have the ISM, the index of U.S. manufacturing. It rose a better than expected 48.9% in July. That's up from 44.8% in June. The stories just keep coming. I'm reading through things and I'm circling things in the paper so I can read them to you. Another headline, Joe Davis, chief economist at Vanguard, states in verbatim, there isn't any part of the economy that hasn't shown some slowing of its deterioration. It suggests recession will be ending before the end of this year. Wow. So again, the articles just keep looking better and better. It doesn't mean that there isn't a twist on the newspapers. I don't know if that's true or not. I don't think about that. What I think about are the articles that I'm reading, what they mean, and I know that you're reading them as well. And what are you going to think, and how is the street going to react? That is what I use the news for. Here's another one. Starbucks climbs to a 52-week high. Traders, Starbucks at a 52-week high. That means that the same people who said a year ago, I'm not spending $3 for a cup of coffee when I can spend 80 cents, are now saying, you know what? I think I'll go spend $3 for a cup of coffee. Hooray, happy days are here again, right? That's not quite what it means, but you can see people are loosening their belts a little bit. Analyst consensus for the current quarter for Starbucks is for a 100% rise in earnings. So people are out there buying their high-priced coffee now. And kid you not, Starbucks got hammered for a while because they lost a ton of business because people were literally saying, hey, I'm not going to spend that kind of money for a cup of coffee. So if they're starting to feel better about their cups of coffee, obviously they're starting to feel better about the economy in general. Then we have Joseph Brusilos, director of Moody's Economy, and he states, no longer, and again verbatim, no longer should we have to discuss when the recession will end, but rather what the economy's recovery will look like. Wow, imagine that. Next, here's another great thing. Warren Buffett's stock swings back into profit in second quarter. Well, as if we didn't all expect that, right? However, as you know, as soon as he started to go down a little, everyone started to look at him and go, oh, he missed. Oh, my God, Warren Buffett missed. Well, you know what? Warren Buffett now is back in profit. Last quarter or first quarter of this year, they logged a $1.5 billion loss the first 3 months of this year. Now, for this quarter, Berkshire Hathaway records a $3.3 billion increase in funds and in profits, a $3.3 billion increase second quarter. Then, of course, you look around at world markets and the FTSE 100, the London stock market, extended its gains on Friday to another new high for 2009, and the best that chart has looked to me in quite some time. So, traders, the news has just been better and better. And I do not trade the fundamentals. I do not trade the articles I read. I will not trade even in the direction that they're pointing. I use the news to see what the street mentality is. Just keeps things in check. Street mentality is things are looking much better today than they did 6 months ago. So with that in mind, I think we're going to just continue to recover. And the beautiful thing has happened, traders. Technically, check this out. Dow Transportation Average is regaining its role, its century-long role, as the leader of the indices. For a while now, NASDAQ was taking the lead. It looks like NASDAQ's gotten back into its usual mode of following the transportation average, and that means markets are getting back to normal, traders, because once we started to head down, the transportation average took us down. It led the way. Once we went down there, it sort of got flat and stopped leading for a while. The NASDAQ and the mini Russell seem to be all leaders. Well, it appears, we'll see what happens, for now that the Dow Jones Transportation Average is beginning to take the lead once again, something that we can all follow, and that's a great thing. What else do we have to talk about in this webinar? T-bonds look bearish once again, traders. I showed you a few charts all during last week in our videos. I put up the T-bonds, I put up my Omni average, and I said, look, every time we tap that Omni average, we break to the downside pretty hard, and that is exactly what the bonds did last week. Now I have some charts I'd like to show you about the indices and about bonds, which should summarize this whole speech we just had. Again, the news looks good. The news always comes out in the charts first. The bonds don't look so good, and that actually fits in our picture, because if bonds are going down, that means traders' thoughts are that interest rates are going to edge back up at some point in time. It doesn't mean tomorrow. It doesn't mean next week. But the market always trades ahead of the news, right? The market's always in the lead of the economy. The market goes, the economy is with it, but behind it. Well, if the world's leaders, or I should say if the largest traders in the world, think that the market's going to continue higher, they also know that means the Fed at some point will have to raise interest rates to cool things off. The bonds heading lower is basically like the future being told. If the bonds continue lower, the traders of the world out there expect higher interest rates at some point. So traders, let's go look at that. Let's go look at some charts. Okay, traders, the first chart you're looking at is the Dow Jones Transportation Average Daily Bar Chart. And of course, as you can see, it's got this beautiful V-shaped bottom action going on. It's gotten past its inverted head and shoulders. It's now jumped out of the right shoulder. But what appears to be very important to me, what opened up my eyes, is the fact that it is now beginning to act as the leader once again of our indice markets. And I'll tell you what, traders, it's been the leader for over a century. I've been a true believer in the transportation average leading the indices. It has taken a backseat to NASDAQ in the last few weeks and months. However, over the last couple of weeks, I should say 2 weeks, it's beginning to show that it wants to once again reclaim its crown and become the leader. And then after Friday's run-up move and the settlement on the highs, it really is beginning to take on that role. So hey, a round of applause for this market, because boy, oh boy, when the trading leads, it becomes a lot easier to see the future. So there's your transportation average, and I want you to see what the leader was for the last couple of weeks and months, because it was the NASDAQ. Look at that picture right there, the run-up, the settlement by the high for Friday. Now we're going to pull the NASDAQ daily bar and look at what it looked like on Friday. Okay, traders, as you can clearly see here in this NASDAQ daily bar chart, we are in a beautiful parallel channel. It is mostly respecting that channel, but on Friday, we did rally and settle at the highs, but it did not look like this, which is what the leader looks like, the transportation average. In fact, this NASDAQ has a flat top, and in many occasions, flat tops produce market drops. In this instance, the fact that the transportation average has emerged once again as the leader, I'm going to follow the leader and not the NASDAQ, because it's about the only index with a flat top. So if it were the leader and many indices had a flat top, I would basically look for the downside tomorrow. The fact that it has a flat top, but the leader, being the transportation average, has a nice bar up here pointing towards the upside, I will be a buyer of dips in that market instead of expecting to sell it, waiting for downside. In other words, our buying of dips posture remains. We will maintain that posture unless these markets completely reverse direction. So we will be looking for the upside, even if there are pullbacks this week in the indices. We will be buying those pullbacks. Now I'd like to show you a few more world's indices and see what they look like. Okay, traders, we are looking at September FTSE daily bar chart. It's had a very nice run up ever since it held the Omni proprietary moving average. And on Friday, it put an outside day to the upside in. In other words, Friday traded lower than Thursday's low, rallied up, traded higher than Thursday's high, and then settled very close to the highs of the day. That, my friends, is considered an outside day up, and is usually an indication that you will move higher. So the FTSE looking really strong here, as does our markets. Even if there is some form of a pullback, we are going to buy the pullbacks. Let's look at another chart here. Okay, traders, another of the world's markets, and one that's been booming lately, it's the DAX, the German DAX September daily bar. And as you can see, this also put in an outside day up as we traded lower than Thursday's low, came up and traded higher than Thursday's high, and then settled up by the highs. It also is holding a very nice support line. So there is a trend line support. There is an outside day up. There is this nice rally that we've already witnessed. There is the fact that the transportation average here in the United States is looking to move higher. I like the indices here, traders. We are absolutely buyers of pullbacks. I know you're hearing a lot on television and you're reading a lot from certain entities that the top is in and we're going to crash. And I say we've already had our crash for this decade. We need to move higher, and I will continue to keep that opinion unless these markets severely break down and show us a total change in direction. Until then, traders, I am looking for the upside. I am a buyer of dips. On any 2-day pullbacks, I would jump right in and go long. For now, with day traders, we will buy the pullbacks throughout the day as they materialize. Okay, traders, the last chart in the indices that I will show you is The Nikkei, it's the Japanese stock market. Look at this. It's just been booming towards the upside, holding a support trend line, and it put a monster-sized rally day in on Friday. It settled right near the highs. The Nikkei is begging to move higher. And as you know, Asia seems to be the first to come out of the recession. At least looking at their charts, you would think so. And look at the way that thing ran up. Now the United States is on its way. You've heard about some good news coming out of the UK. I think we're definitely in a bull market here, or at least in the beginning stages of a nice long recovery to come. I don't know if you see it that way, but I hope you do when you look at a chart like this. If this were the only chart to look at, you'd have no choice but to just be long and expect much higher. Pull your indices charts and take a look at them. Now, traders, let's go look at the bond chart. Okay, traders, you are now looking at September daily bond chart, and I have shown this to you at least in 3 or 4 videos already. And what we wanted to illustrate was each time the market touches the Omni proprietary moving average, a pretty decent sized decline ensues. Has a big decline, comes up, touches the Omni average, and has a big decline. Comes back up, touches the Omni average. The night it touched the Omni average, I started putting these charts before you to tell you, watch out for downside. 1 down day, 2 down days, 3 down days, 4 down days, and the beginning of what looks like to be another since we tapped the Omni average. Bonds, indicators on bonds look bearish still. Once we take out this low, we can actually challenge this low down here below 112. So keep your eye on bonds, and it looks like we need to sell the rallies in the U.S. 30-year bonds. By the way, the 10-year bonds, or the 10-year notes, I should say, look basically the same. So look at your 10-year, look at your 30-year, and you should be thinking about selling the rallies in those two markets. So, traders, you see those charts? I really hope that these weekend webinars help to keep you in tune of the larger picture, because I'll tell you what, traders, the larger picture is all we have to figure out how to be short-term traders. You got to know how to read the street. You got to know how to read the direction, and then from there you can come up with your short-term trades. So always do your homework. Look at the broader picture first, then break it down to your daily trades and see what it is you want to do. All right, traders, so remember, transportation average is truly beginning to emerge once again as the leader of the indices, and bonds once again has a red on. They go bonds to the downside. The lower bonds go, the more likely it is that interest rates at some point will go higher, and the only way our Fed would let that happen is if they had some good figures showing that the stock market wants to boom. So let's hope it actually happens, because that will make stocks be much, much higher if it actually does turn out to be that scenario. We'll see what happens. Traders, I didn't show you a couple of charts. One of them was sugar, actually sugar and coffee. Sugar is at a 28-year high. A 28-year high, and it doesn't look like it's coming back anytime soon. The coffee's starting to go up behind it. Orange juice is starting to rock and roll. A lot of commodities are starting to go. The soybeans are as bullish as can be on pullbacks. Same with the soy meal. I will say the meats and the corn, wheat, and oats have not really participated in this move yet. If our dollar continues to get pounded, they will start to move higher. Now, there's also something else interesting that happened, which involves the gold market. The European central banks have lowered the amount of gold that they can legally now sell within 1 year to 400 tons. That's a 20% decrease in the amount of gold that they can lay off on the markets. That should equate to a higher price in gold at some point. Now, traders, I think silver and gold are pure spec markets. I really do. At this point in time, they're not using them for hedges against inflation. They're speculating in there. So I don't know that Europe lowering the amount of tons of gold they're allowed to sell will mean anything, but it should give it a little bit of buoyancy, because it should. I mean, if they can sell less gold, people know that. Traders know that. And maybe it'll buoy the price of gold. But again, I think of the metals, those two have been pure spec plays. Then you have copper and platinum and palladium. The three of them are used in making cars, and cars are starting to sell once again. Keep your eyes on those markets. The copper has just been booming. So keep your eye on platinum and palladium and copper. Look, platinum, palladium, copper, sugar, orange juice, the industrial products are starting to go. That means that they are ahead of the news usually, and the news, if you're looking at that as an indication, means this world is starting to churn again. Business is starting to happen. Slowly, we should recover here. Again, I'm a day trader. If it turns around and starts dumping, I'll turn into a bear if I have to. But I see a difference here from what we've seen in the last year and a half. I'm seeing a slow, steady market. I see the S&P starting to gain some legs, and I think we're going to move higher as time goes by. Again, pullbacks are welcome, because if the markets pull back, we'll buy into it in the indices. Let's see what happens. All right, traders, so that's the wrap-up that I've seen so far in my homework over the weekend. I also looked at indices. I looked at currencies. Indices, currencies again, guys. I looked at the currencies, and what I have noticed was that if euro currency does head up today, Monday, then we're right back into buying it again. There was a big dip on Friday. I am a believer in two-day dips, so if there was a Monday dip, I'd be ready to jump in. But if it turns around and goes straight up on Monday, then the markets are right back in full swing, because the dollar index opposite of euro currency looks the exact opposite. Looks like it needs a two-day rally before heading back down. It had a rally Friday. I'm thinking you'll get a rally Monday, at least half of Monday, and then we could sell the dollar, buy the euro currency. But we'll handle that as it happens. For now, I am not giving a rec in dollar or euro currency, but I do have recommendations in the U.S. indices and in the 30-year T-bonds at our site. Our site is www.livewithoscar.com. Come on down to the site. Jump into the free chat rooms. Don't trade alone. Come on down to the site and join the ever-growing army of Omniacs that keep coming down to the site to learn from one another and from the Trading Academy every day. And I'll tell you what, traders, when you are trading with a group of people and you're all trying to help one another, it is way easier than sitting by yourself trying to figure out what to do next. So come on down to our site. You know what? I think I'm done here. I think I illustrated the charts that I had to illustrate. I think that I told you about the sugar and the coffee and the cocoa. Well, actually, cocoa wasn't there. Cocoa, it looks to me like it has a double top. But the sugar and the coffee are really looking smart here. OJ doesn't look so terrible either. So take a look at those softs. All right, traders, if you like this video and do not know how you found it on YouTube, simply hit the subscribe button, subscribe to our videos, and then every time we put out a video, YouTube will send you an email if you have your YouTube up and running. All right, traders, again, make sure you come on down to the site. Give me a call anytime, day or night, 702-629-4755. And as always, keep your emotions out of trading. One of the best ways you can do that is to say this to yourselves every morning, every afternoon, every evening. And you know what that is? Stops are in. Emotions are out. Futures trading is risky and can cause substantial financial loss. We do not claim or guarantee that you will profit from the information provided. That being said, I'm a 27-year seasoned trader on and off the trading floors. This is how I've made my living for many, many years.